Hey everyone, welcome back to Corporate Decoder, the place where we unpack financial secrets and see if companies are really as shiny as they seem. Today we're looking at a report from Oncor Electric Delivery Company LLC. Now this isn't your typical quarterly earnings report, but it has got some interesting financial moves baked into it. Stick around to see what they've been up to behind the scenes. Before we dive in, if you like getting clear, no-nonsense insights from corporate filings to help you make smarter decisions about your money, make sure you hit that subscribe button. We break down complex financial documents so you don't have to. Also, we've got a fantastic community over on Discord sharing insights and helping each other out, so you'll find the link in the description below. Alright, so Oncor Electric Delivery Company, LLC, sometimes just called Oncor, filed this report back on the 26th of September 2025. It is a bit of a special filing, a current report that essentially tells us about a significant financial event. It is not about day-to-day operations, but rather a specific deal they've made. The main news here is that Oncor has completed a pretty big sale of notes. Think of it like the company borrowing a large sum of money, but instead of going to a bank for a loan, they reselling debt, specifically 4.20% senior secured notes due in 2035. That is a lot of money and a long time to pay it back. To be exact, they sold $500 million of these notes. Now, while the notes are in Canadian dollars, they've used something called cross-currency swaps to effectively turn this into a fixed-rate deal in US dollars. This is a smart move to protect themselves from wild swings in currency values. The actual cost in US dollars, all bundled up, is about 5.022%. So what are they doing with all this borrowed money? Well, they're reusing the nearly 494 million Canadian dollars, which works out to about 357 million US dollars, to be exact, to fund their general business needs. A big chunk of which is to pay off other short-term debts they have. This often happens when companies want to refinance their debt to get better terms or longer repayment periods. These notes are important because they are secured, meaning they are backed by specific assets of the company. Specifically, they rebacked by a lien on all the property Oncor uses to transmit and distribute electricity. This gives the note holders extra security. The notes themselves will pay interest twice a year on the 1st of April and the 1st of October, and they due to be fully paid off by the 1st of October 2035. Now here is where things get a little more interesting from a financial management perspective. Oncor has the option to pay back these notes early. Before the 1st of July 2035, they can buy them back at their face value plus any owed interest and an extra fee called a make-whole premium. After the 1st of July 2035, they can simply pay them back at face value plus interest. This flexibility allows them to potentially refinance if interest rates drop or if they have surplus cash. They also have the right to redeem the notes if certain tax events occur, which is a standard clause in these types of agreements. There are also standard default clauses, like if they miss payments. If such a default happens, the whole amount of the notes could become due immediately. This report also lists the exhibits, and the key one here is Exhibit 4.1, the Officer S Certificate. This document is essentially the official confirmation that sets out all the specific terms and conditions for these new notes. It's the legal blueprint for this borrowing. The filing also references other past documents like the indenture and the deed of trust, which are really the foundational legal agreements that govern how Oncor can issue debt and what assets are used as security. These are incorporated by reference, meaning they are considered part of this report even though they were filed at different times. And finally, like most filings these days, it includes an exhibit for the interactive data file, which makes it easier for computers to read and analyze the information. This is all about making financial data more accessible and standardized. The report is signed by Kevin R. Fees, who holds the title of Vice President and Treasurer. This is the person officially confirming that the information in this report is accurate and true to the best of their knowledge. The report is dated the 29th of September 2025, which means it was filed just a few days after the note sale transaction occurred. So what does this all mean for Oncor? Well, they effectively secured a significant amount of long-term funding. By issuing senior secured notes, they re-strengthening their capital structure and likely aiming for more favourable borrowing costs and longer repayment periods than they might get with shorter-term debt like commercial paper. The use of cross-currency swaps shows a sophisticated approach to managing financial risk, particularly foreign exchange fluctuations. This is good for stability. The fact that these notes are secured by their core assets means they putting up valuable infrastructure as collateral, which is a common practice for large utility companies, and it provides comfort to investors. On the flip side, issuing more debt always adds to the company's financial leverage. While this debt is long-term and secured, it is still a commitment to pay interest and principal over many years. Investors will be watching to see if Oncor can consistently generate enough cash flow to cover these obligations, especially with those make-whole premiums for early redemptions. The company's operational performance and ability to manage its infrastructure effectively will be key to ensuring these debt obligations are met without issue. In my opinion, Oncor is making a strategic move here to solidify its financial foundation and likely pave the way for future investments, or perhaps to simply manage its existing debt more efficiently. It is a sign of maturity in their financial planning. The currency hedging is a particularly smart tactic in today's global financial environment. The risks are fairly standard for a company of this nature and size that utilizes debt financing. The opportunities lie in their ability to leverage this stable funding for growth and efficiency improvements across their vast energy delivery network. Alright, that is our look at Oncor Electric Delivery Company LLC's recent note issuance. What are your thoughts on this move? Are you comfortable with companies taking on debt like this to fund operations? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more regular corporate financial deep dives. And don't forget to join our growing community on Discord for more exclusive content and discussions. Thanks for watching. Until next time.